Investing is one of the best ways to make sure you have money in the future, and one of the best ways to invest is over a long period of time. In the past few years, it may have been tempting to ditch a long-term plan and look for quick returns. But with the market's high prices right now, it's more important than ever to stick to your plan and focus on investing for the long term. We'll tell you about the best long-term investments for 2022 in this video. But before we start our video, please click the bell icon and subscribe to our channel. So let's start. 1. Growth stocks. When it comes to investing in stocks, growth stocks are like Ferraris. They promise a lot of growth and a lot of money back on investments. Usually, tech companies are growth stocks, but they don't have to be. They usually put all of their profits back into the business, so they rarely pay dividends, at least until their growth slows. Growth stocks can be risky because investors often pay a lot for them compared to how much money the company makes. So, when a bear market or recession hits, these stocks can quickly lose a lot of value. It's like their sudden fame goes away in an instant. But over time, growth stocks have been among the best investments. If you want to buy individual growth stocks, you'll need to do a careful analysis of the company, which can take a long time. And because growth stocks are volatile, you should be willing to take on a lot of risk or plan to hold on to them for at least 3 to 5 years. Risk. Investors are willing to pay a lot for growth stocks, which makes them one of the riskier parts of the market. So when bad times come, these stocks can go down a lot. Reward. However, the biggest companies in the world, like Alphabet and Amazon, are high growth companies, so the reward could be unlimited if you can find the right company. 2. Stock funds. If you don't want to spend the time and energy to analyze individual stocks, an ETF or a mutual fund can be a great alternative. If you buy a widely diversified fund, like an S&P 500 index fund or a NASDAQ 100 index fund, you will get a lot of different stocks, including some with high growth. But you'll have a safer and more diverse group of companies than if you only owned a few stocks. If you want to be more risky with your investments but don't have the time or desire to make investing your full-time hobby, a stock fund is a great choice. And if you buy a stock fund, you'll get the weighted average return of all the companies in the fund. This means that the fund will usually be less volatile than if you had just a few stocks. If you buy a fund that isn't widely diversified, like one that only invests in one industry, you should know that it will be less diversified than a fund that invests in a broad index like the S&P 500. So, if you bought a fund based on the auto industry, it might be very affected by oil prices. If the price of oil goes up, it's likely that a lot of the stocks in the fund will lose value. Risk. Buying stocks one at a time is riskier and takes more work than buying a stock fund. But it can still change a lot from one year to the next. In some of its most extreme years, it could lose as much as 30% or gain 30%. Reward. A stock fund is easier to own and keep track of than individual stocks, but your returns should be more stable because you own more companies and not all of them will do well in any given year. With a stock fund, you can also make a lot of money. 3. Bond funds. A bond fund, whether it's a mutual fund or an ETF, is a group of bonds from many different companies. Bond funds are usually put into groups based on the types of bonds they hold, such as the length of the bond, how risky it is, who issued it, and other factors. So, if you want a bond fund, you can choose from a number of funds that fit your needs. When a company or government issues a bond, it agrees to pay the bond's owner a set amount of interest every year. At the end of the bond's term, the issuer pays back the bond's principal amount and redeems the bond. A bond is one of the safer investments, and when it's part of a fund, it's even safer. Because a fund might own hundreds of different types of bonds from many different issuers, it spreads out its holdings and makes it less likely that any one bond will cause its portfolio to lose money. Risk. Bond prices can go up and down, but a bond fund will stay mostly the same, though it may move when the interest rate changes. Compared to stocks, bonds are thought to be safer, but not all bond issuers are the same. Government issuers, especially the federal government, are thought to be very safe, while corporate issuers can be anywhere from a little bit less risky to a lot more risky. Reward. The return on a bond or bond fund is usually much lower than it would be on a stock fund, maybe 4 to 5% per year, but less on government bonds. It's also a lot less dangerous. 4. Dividend stocks. Dividend stocks are like sedans compared to growth stocks, which are like sports cars. They can give you good returns, but they won't go up as quickly as growth stocks. A stock that pays a dividend, which is a regular cash payment, is called a dividend stock. There are dividends on a lot of stocks, but they tend to be more common in older, more established companies that don't need their cash as much. Dividend stocks are popular with older investors because they provide a steady income. The best stocks also increase their dividends over time, so you can make more money than with a fixed bond payout. REITs are one type of dividend stock that people often buy. Risk. Dividend stocks tend to be less volatile than growth stocks, but that doesn't mean they won't go up and down a lot, especially if the market is having a rough time. But a company that pays dividends is usually more mature and well established than a growth company, so it is usually thought to be safer. Still, if a dividend-paying company doesn't make enough money to pay its dividend, it will cut the payout, which could cause the price of its stock to drop. Reward. One of the best things about dividend stocks is that they pay out money. Some of the best companies pay out 2% or 3% a year, and sometimes even more. But most importantly, they can raise their payouts by 8 or 10% per year for a long time, so you'll usually get a raise every year. Even though the returns can be high, they are usually not as high as with growth stocks. You can also choose a dividend stock fund to own a wide range of stocks. There are many of these to choose from. 5. Real estate. In many ways, real estate is the best type of investment for the long term. It costs a lot of money to get started, the commissions are high, and most returns come from holding an asset for a long time, not just a few years. Still, a 2021 Bankrate study found that real estate was the best long-term investment for Americans. Real estate can be a good investment because you can borrow most of the money you need from the bank and pay it back over time. That's especially popular as interest rates sit near attractive lows. People who want to be their own boss can do so if they own a property, and there are many tax laws that help property owners in particular. Even though real estate is often thought of as a passive investment, if you rent it out, you may have to do a lot of work to keep it in good shape. Risk. When you borrow a lot of money, you put more pressure on an investment to do well. But even if you buy real estate with cash, you'll have a lot of money tied up in one asset. This lack of diversification can cause problems if something goes wrong with the asset. Even if you don't have a tenant, you'll still have to pay the mortgage and other costs to keep the property in good shape out of your own pocket. Reward. Even though the risks can be high, so can the rewards. If you choose a good property and take good care of it, you can make many times what you put into it if you are willing to hold on to it for a long time. And if you pay off the mortgage on a property, you can have more stability and cash flow. This makes rental property a good choice for older investors who want to make money. That's all we have for today. If you enjoy watching the video, give it a like and also don't forget to subscribe to our YouTube channel. Press the bell icon for all the latest updates.